Now it's time to bring in two special people. First of all, my good friend and co-host, Jeff Small, an income specialist from Melbourne, Florida. And also our first guest, Dr. Gary Shilling. He's a financial analyst, a commentator, and the president of Gary Shilling and Company. He's also the editor of Gary Shilling's Insight. Professor Shilling, thanks so much for being back with us here on the Income Generation.
Glad to be with you.
So, Dr. Shilling, what's the top piece of advice you can give our viewers and our listeners on how to create income when they first get into retirement?
Save more. Most people, what they end up with at the end of the day when they go into retirement is what they saved, not what they made through investments. Yeah, sure, investments are fine. They do improve the situation. But if you look back historically, when people have assumed that investments were going to do the job and they saved less, they usually were setting themselves up for disappointments. That happened in the 1990s. You had 5 years of the S&P 500 rose over 20% in 5 successive years, and people cut back on their saving, but they learned to regret that. So you do need investments, but you can't rely on them to do the job.
That's a really good point. I kind of feel like we're at the end of the 90s again with this all-time market peak. Do you feel the same way?
Yes. I mean, if you look right now, and I'm looking at a sheet here of price earnings ratios for the NASDAQ, the S&P, and the Dow, and they all are about twice. They've just about doubled in the last year, ever since things took off back in March with all the monetary and fiscal stimuli. But they're way, way above any historical norms. And I think it makes investments in equities very risky.
Yeah, I agree with that sentiment. I guess the COVID economy and the rise of the NASDAQ and the digitization side of the economy occurring really facilitated growth in that sector. And this year it seems to be a rotational move into value type based stocks and away from the high flyers of last year. And so when does this trend end? When do you see this bubble popping? Because obviously we're creating this huge asset bubble.
Well, you have had a rotation. You did have the tech stocks flying, but one thing that we pointed out in our monthly newsletter that you mentioned, Insight, was that a lot of the value of tech stocks is the discounted future earnings. And because most of them, their earnings are way, way out there, many years out. Well, the higher the interest rate, the less those earnings are worth presently. And that's what one theory is, that's what constitutes the stock price. And of course, many people are looking for higher interest rates, and they have risen a bit in the last year. And I think that's put a damper on the tech stocks. And you've also had the rotation to the more economically, fundamentally based stocks because of the anticipation of a big surge of consumer spending on reopening the economy.
That's right, the recovery, the big recovery trade, Dr. Shilling. So all great points, Dr. Shilling, Jeff. We can take commercial break. Look forward to having you back just after the break. And you stay with us. We're going to talk more about your money and talk more about the things, again, you need to know to have a stress-free retirement. We'll be back in a moment right here on the Income Generation. Welcome back to the Income Generation. I'm David Scranton. Of course, I'm here with Jeff Small and today's special guest, Dr. Gary Shilling. Dr. Shilling, thanks so much for sticking around.
Glad to do so.
So, Dr. Shilling, we've been hearing a lot of talk about potential inflation, but you said you see deflation more likely. Can you tell us why?
Yeah, well, inflation is fundamentally a matter of demand exceeding supply. Now, that typically happens in wartime when governments are spending a lot of money on top of a fully employed economy. Demand exceeds supply, you get inflation. But today we have globalization. You have a huge production in China and other Asian countries, and they're big producers, big exporters, but they are very parsimonious spenders. So they have excess saving. There's a savings glut. In other words, their supply greatly exceeds their demand. And this is big enough on a worldwide basis to basically put downward pressure on prices. I think that's a fundamental factor. Now, you do have temporary factors, some are reopening the economy, supply chain disruptions, and so on. But if you want to look on this on any time of a time frame, and I'd say 6 months or a year, the downward pressure is on prices.
So you think that'll even be facilitated by the rise in energy prices that we've had this far, because gas has gone up, 45%.
Yeah, well, you've had a jump there. You've had just some disruptions. You had big storms in January on the Gulf Coast, which disrupted production and so on. But OPEC is now increasing their output. They desperately need the money. They've got big spending plans. I look on that as fairly temporary.
So the stock market then, as per our last conversation, you're really concerned about a correction happening at some point. So when will that correction happen, do you think, and how severe will it be?
That's a tough question because stocks are way, way overpriced right now. But what's going to end the party? The Federal Reserve is pumping money out. We've got all kinds of fiscal stimuli, the latest $1.9 trillion. And now we've got coming up the infrastructure and related bills. This money keeps coming out, and you say, what's going to end the party? Could be that things simply get so high that they collapse of their own weight. That happened with the dot-com stocks in the late 90s, and it could happen again. Whether we're close to that point or not, who knows?
And Dr. Shilling, if you think about what's been happening too, I agree with the deflationary pressure we're seeing, especially aging population, et cetera. It's in part a demographic thing. But what we had up till now is not so much traditional inflation, goods and services, but we've had asset inflation because all the money that the central banks are using to flood the economies, that's being saved, it's being invested. So could that be the thing that keeps the market perhaps levitating at a higher value for a period longer than maybe logic would indicate?
Yeah, in our recent newsletter, we talked about the various types of inflation, and financial asset inflation is one of them, and that's what we've clearly had. All the money that's been pumped out, particularly by the Federal Reserve, has not gone into spending on goods and services, right, into new capital equipment and so on. It's really gone into equities.
Mm-hmm. So in other words, not a great thing for savers as interest rates are driven down, but a great time potentially for investors who know what to do with their money. Well,
so far it is. Now, again, as they say on Wall Street, trees don't grow to the sky. And I think, with the height of stocks in relation to earnings and the prospects for earnings and the fact that the economy is opening, but it's opening slowly. And the big question is, are consumers really going to spend all this money? So far, they haven't. You look at the big stimulus that came out a year ago, right, and they saved 79% of it. Yep. They saved almost the same amount December's round. We'll see what happened with this latest round last month. But so far, consumers are rebuilding assets. They're cutting back on debt. They're not just sitting there with a bunch of money that's burning holes in their pockets.
We're essentially following the steps of the Japanese from 20 years ago or so. So Dr. Shilling, thanks so much for being such a good friend of the income generation and coming back on the show with us.
Pleasure. Thank you very much.